What's up everyone, it's Caddy with MoneyVest. So in this video, I wanted to go over how the markets are playing a very dangerous game of chicken with the Fed. And I'm going to break down some very important data-driven analysis to better understand, the markets right now pricing in, what it's pricing in, and what could potentially take place, and how the markets might have to readjust to the new expectations that may come across in the next couple of quarters. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below. I did open up 2 to 3 more spots if you are interested in joining. You get access to all the members only private videos. There's over 42 videos that I've already done for members only that you can watch and of course gain additional value. And there's also going to be intrinsic value spreadsheets, or different types of cheat sheets like for volatility, for our indicators, and of course not to mention our trade alerts, our Discord channels. Everything's going to be available with the link down below. So we'd love to have you on board. So this right here is the chart that I think has gained a lot of traction, only because every time the Federal Reserve cuts rates, in other words, cuts rates or pauses rates, I should actually say only pauses rates, not cutting. Only when they pause rates is when the S&P 500, which is just the market in general, rallies, right? We see a significant momentum to the upside because that signals the market that we are done, right? We are done with rate hikes, and there is going to be a pause, and there's possibility for quantitative easing. So you can see that going back as far as 1980s, the Fed pause has been a reliable buying signal since the early 1980s, right? So every time the Fed pauses, we see the S&P 500 rallies 104% to all-time highs. This right here, Fed pauses in 1989, S&P 500 rallies to all-time highs, 39%. In 1995, the S&P 500 rallies 166% to all-time highs, and over here the Fed pauses and the S&P 500 rallies 11% to all-time, not just 11%, not to all-time highs. And in 2006, S&P 500 rallies 28% to all-time highs after the Fed pauses their rate hike cycle. In 2018, same thing. The Fed pauses and the S&P 500 rallies 44% to all-time highs. Now, we've already seen the Federal Reserve pause interest rates, right? It's been a couple meetings now already that they haven't changed the federal funds rate. It's been sitting at 5.25 to 5.5%. So much so that the markets are pretty much expecting the Federal Reserve to keep rates at where they are, right? Keep rates steady, higher for longer, and then start the rate cuts in May of next year. And that's going to be 4 rate cuts is what the market's pricing in. This right here is another really interesting chart. And this is the other side of the equation that I wanted to go over. So after the pause, when the rate cuts actually do begin, the market drops, okay? So this chart shows you that when the rates get paused, the market rallies. This chart shows you when the rate starts cutting, when the Federal Reserve starts cutting rates, is when the markets drop, right? So 1969, the Fed pivots, in other words, starts cutting rates, and we see a 36% decline. Then we see a 48% decline in 1973. Then we see a 27% decline in 1981. Then we see a 51% decline in 2000. Of course, in 2007, we see a 58% decline. So these are all significant market crashes, right? These are bear markets, crashes, full-blown, sell-offs in the market, accelerated sell-offs in the market. 2019, the Fed pivots, 35% decline. And 2023, of course, is a question mark with a Fed pivot, right? Rate cuts and what that's going to do to the market. Now, the key difference, the only difference, one word that's going to cause a lot of this uncertainty, and we're going to get a lot of answers if we can answer that question, and that one word is going to be recession. Okay? The only difference here is you see the pauses here and the market rallies, but then that leads to a recession, which leads to the Federal Reserve cutting rates. And yes, on paper, and when the market's forward-looking, rate cuts are supposed to be stimulating the economy. That's supposed to be quantitative easing. But the Federal Reserve's, the reason why they're cutting rates in the first place is because there is a recession. You take a look at a lot of these dates in 1969, so we're going back over 50 years. Come over to our recession spreadsheet. By the way, a lot of these economic research reports are going to be available for all of you. You can check these out for yourself. And these are the 7 to 8 recessions that are over here. So 1, 2, 3, 4, 5, 6, 7, right? So we're looking at 1969. That's over here, 1969. Then you move over to 1973. That's going to be this one right here. Just highlight those. 1973, that's this one right there. 1980s, you can see 1981 over here. That's also 1981, 1982. 1990, 1991, right? So that's 2000s, a little bit later. 2001, so right there. And then we've got 2007, of course, the great financial crisis. That's over here. And then we got 2019, which is going to be 2020, basically, right? Recession of 2020. So every single rate cut, right, in the past was accompanied by a recession, okay? We started cutting interest rates when there was a recession. Of course, there was other times when there was no recession. So in other words, over here, you'll notice the Federal Reserve is cutting rates a couple times, and the markets continue to rally higher, right? So we are seeing a little bit of that momentum, even though the Federal Reserve is cutting rates. So the most important thing to understand here, and whether this Fed pivot, right, which is the pause and then the eventual cut, is going to lead to a market rally, is for us to understand whether there is a recession or not. That's the most important key takeaway that I want you to have from this video. Because if there is a recession and the market is disqualifying all the indicators, or it's not pricing in for a potential recession, then later down the road, when it actually does happen, even if the Federal Reserve cuts interest rates, the probability for markets to go down is significantly higher because it's happened in the past. And in my previous videos, I've explained this very concept that the Federal Reserve needs a reason to cut rates, okay? They're not going to wake up one day and just cut rates for the sake of it. They need a reason, right? And that reason could be recession. That reason could be deflation. That recession And that reason could be a recession. That reason could be deflation, but they need a reason. They need something to fix, right? If they don't have anything to fix, they're not going to simply cut rates just because there's political pressure or just because there's other market expectations expecting them to cut rates. They need a reason. And that's exactly what they have done. They've always found a reason to cut rates. I mean, every single time they've cut rates is because of a recession. Now, if you take a look at the indicators right now, so if you go forward, and I'm just going to run through the recession first, and that's the big question, right? And I want everyone's participation in the comments down below. What is the probability of a recession, right? Nobody really knows, of course. I'm not asking you to make a prediction, but more like an analysis of, okay, where we are and what current indicators, where are we sitting at the moment, and what's the probability, right? What's the likelihood of that happening, right? And unemployment sitting at 3.9%. Third quarter GDP sitting at 4.9, which came in super strong. The PMI, which is the Purchaser Managers Index, sitting at 50. So it's kind of like in the middle range. In the past, when this number is dipped below 40 or anything under 50 is considered to be a slowdown in the overall economy. But it's been hovering around 47 to 50 levels. And right now, as of the 1st November, we got that number at close to 50. And you can see that 2019, when we got the recession for the pandemic, this index dropped down to 34 to 35 levels, right? So very, very low levels. So this right now at 50, kind of like that average value. Yield curve is inverted. The 10-year, 2-year spread is negative 26 basis points. Jobless claims continue to be very, very subdued at 200,000. Job openings are 9.5 million. Credit card debt is over 1 trillion, and delinquencies are 2.75%. So, there's some indicators like unemployment and GDP growth, which are the most important indicators for recessions, still showing very much of a resiliency and a strong economy. But yield curve and spreads are showing signs of potential recession. Jobless claims and JOLTS numbers continue to be super strong. And credit card debt obviously increasing with delinquencies at 2.75%. So if you take a look at delinquency rates, they're sitting at 2.75%. But in the past, you'll notice that in 2006, 2007, they were at around 3.5 to 4%, and then immediately spiked to 6.5% during the Great Financial Crisis. But more specifically, you'll notice that we are on the way up. So we are seeing a significant move to the upside. So if it continues to move up, if there are high levels of delinquencies with the level of credit card debt that we have, it's possible that once again creates an environment where that ripples into some of the other sectors of the economy, like auto loans, mortgages, and if there's more and more foreclosures or delinquencies, that obviously is going to lead to bigger problems for the economy as well. Now, one more thing I want to point out is, why is employment so strong, right? Why is employment so resilient? So 161.4 million people employed right now in the US, and S&P 500 only controls 17% of the workforce. So that was actually quite interesting data point, because it's only 17% of the workforce is from S&P 500. Then small medium businesses, basically small and medium businesses, is the heart of the United States employment and the workforce. 83% of the workforce is employed by SMBs, right? Small medium businesses. And between private and public, so private is 85.3%, public's 14.7%. And the reason why this number is lower than this number right here is because S&P 500 may have private subsidiaries or government contracts, which accounts for both private and public employees. So really the public market, which is the stock market, 4,200 companies combined, only makes up less than 15% of the workforce, and 85% comes from private companies, small, medium businesses. That's at the core and the heart of the workforce. And there's over 33 million businesses in the US, right? Between private and public companies, and public are only 4,200. So there's significantly more, private companies, that control majority of that employment. And we don't have any financial data, right, for those companies, because these are private, so they're not required to disclose anything. But it does seem like they're very well capitalized. They're still, strong. They're still hiring, and job openings continues to go up. And for that reason, we continue to see employment as strong as it is and as resilient as it is. And this is probably one of the biggest important markers as a starting point. If unemployment starts to go up, it's going to kickstart everything else. It's literally like a wheel which is not turning yet, but as soon as employment starts to turn, right, that's going to kickstart everything else. It's going to literally start everything, because as soon as unemployment goes up, delinquencies go up, spending goes down, earnings goes down, economic growth starts to slow down. Like it's like that's really what starts everything. So our analysis, our question really needs to be phrased in a way: is there unemployment showing weakness in the private market, in the small medium businesses? Some indicators are suggesting that. And then if so, how severe? And if so, is that going to lead to high levels of unemployment in the future, which could potentially lead to recession? Because look, if there is a recession in the next couple of quarters, okay, and there are, again, a lot of economists suggesting there might be something of an economic contraction over the next couple of quarters, the market may have to reprice all of that, may have to readjust to that, because in the short term, yes, markets do drop on the back of recession and rate cuts, but in the long term, of course, those end up being buying opportunities. So I don't want you to, take away from this video that, if there's a recession, the market's going to drop. No, that's actually a good thing, because that's going to create a lot of opportunities for us to take advantage of when that happens. Because a lot of these sell-offs, 51, 50%, 35%, they end up creating what? Opportunities, right? Opportunities, windows for us to be more aggressive and dollar cost average at those levels for when the economy is struggling and, of course, markets are coming down. So that's what I wanted to go over in this video. Let me know your thoughts down in the comment section below. Rate pause is great for the market, and yes, it can lead to a rally, but it's also because eventually the rate cuts came in on the back of recessions. Now, the market's not pricing in for one. I don't think it is. So there is a little bit of repricing risk if we see a recession. And of course, the leading indicator for that is going to be employment, which is mostly controlled and dominated by private companies and small, medium businesses. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. And link to our Discord, Patreon is going to be down below if you're interested in joining. So always happy investing. I'll see you all in the next video.